Good morning. How the 1% structure their real estate loans for tax efficiency. And most borrowers focus on interest rates, whereas the top 1% focus on structure. So high net worth individuals, seasoned investors, doctors, dentists, and business owners understand that the real advantage in real estate comes from how the loan is structured and not just how cheap the rate looks on paper. And what I'm saying is the right structure can legally reduce your taxes and improve your cash flow and accelerate long-term wealth building. And as a mortgage broker, this is where strategy matters. So let's talk about a few topics. Asset-based lending over income-based lending. Well, the 1% prioritize asset performance and not W-2 income. But instead of traditional underwriting that relies on tax returns, elite borrowers will often use DSCR loans, bank statement loans, and commercial cash flow underwriting. And these structures will allow qualification based on property income, but also preservation of tax efficient write offs, as well as the continued use of aggressive depreciation strategies, especially if you make use of cost segregation. And this is especially powerful for investors and self employed borrowers who intentionally minimize taxable income. Two is separating properties by entity structure. Wealthy borrowers rarely hold real estate in their personal name, is the takeaway. So, what can they use? Well, they'll use LLCs, series LLCs, trust structures, and you really need legal advice on that topic. But there's definitely situations where that's helpful. And why does this matter though? Because it has cleaner accounting, it has enhanced liability protection, but it is also easier on expense allocation, which translated gives you more flexibility with depreciation and cost segregation strategies. But loan structure in any structure must align or tax advantages can be lost. So, three is long term fixed debt to maximize your depreciation. Well, the 1% favor long term fixed rate debt when depreciation is the goal. And why? Well, there's predictable payments. You get a stable cash flow reading, and you can also make full utilization of depreciation and interest deductions. So, this approach is more common with DSCR loans or portfolio commercial real estate loans once they've been bundled together. But there's also select non-QM residential products that fit that mold. Short-term debt may look cheaper, but long-term structure wins on taxes is the point. So, four is strategic use of cash out refinances. And rather than selling and triggering a capital gains event, higher net worth investors will often refinance properties and pull equity out tax free. And then at that point, reinvest into new assets. And what this does, it allows capital redeployment without triggering taxable events, and also portfolio growth while deferring taxes. But definitely preservation of stepped up basis strategies for your long term holds. And loan timing and structure are definitely critical here, is a good point. But five is you need to align your loan strategy with the CPA and advisory team on your side. The 1% never structure loans in isolation, and they coordinate with multiple parties. So think your CPAs, your financial advisors, your estate planning people. But also a strong mortgage broker is going to understand how to advise and structure debt to complement the tax strategy you guys have achieved or set out as a plan, but also avoid disqualifying deductions, which in turn supports your long-term planning goals. Now, this is where a broker beats a bank every day. It's flexibility and strategy. So let's look at why mortgage structure matters more than rates. Well, banks sell rates and the 1% buy the structure is the point. And when loans are designed correctly, borrowers can gain. And usually that shows up in a lower effective tax burden, but also higher after tax returns and stronger long term wealth outcomes. And this really is the difference between qualifying for a loan and engineering a portfolio. Work with a mortgage broker who understands strategy. That's what I'm here for. And at Medallion Funds, we specialize in DSCR and asset based lending, also high income professional mortgage strategies, but also investor and portfolio loan structuring. And we coordinate financing with tax efficiency in mind. So if you want your loans structured like the 1% and not just the average borrower, it starts with the right conversation. My name's Bill. My website is billrapponline.com. Please reach on out. You can find me there, and we'll talk more about your situation. Take care.